I'm delighted to say we are ready to go. Welcome to our final session of the day. We're joined here now by Georgina Brittain. Georgina has managed the JPMorgan Smaller Companies Trust since 1998 and is one of the most experienced managers in the sector. She's delivered an annualised return since her appointment in excess of 12%, outperforming a peer group and the benchmark by a significant margin. And earlier today, we heard her describing the excitement she felt about the outlook for small and mid-cap companies. With Brexit behind us and the COVID crisis finally looking like it might be under control, we heard how excited she was. I'm going to hand you over to her now and find out exactly what it is that she's excited about. So here she is, Georgina.
Thank you very much, Pascal. So hello again to those who joined the panel. And I'm just going to say kind of immediately, it's been a pretty busy day my end, so I couldn't stay and listen to the other participants in their presentations. So I really hope it's not too repetitive. I think you got quite a feeling, as I say, if you join that panel, that we are actually all thinking the same way. Hopefully that's not just groupthink. That's actually because there are real justifications and reasons for that. And I'm going to go into a few of those in the next 20 minutes or so. But first of all, just a quick summary of our Smaller Companies Investment Trust that, as you heard, I've been running most of my life. And my co-manager, Katan, joined me almost a decade ago now. So these are very largely his figures as well as mine. And the third member of our team you'll hear a little about during this presentation is Ed, who's done a huge amount of work and been a serious contributor to our success. So as you can see, our benchmark is the newest Smaller Companies plus AIM. And we currently are, well, over 350 million market cap, and we have almost 90 stocks in the portfolio. That for us is quite a high number. There isn't a correct number, there isn't a wrong number, but generally we would tend to be around the 80 mark. And then there are two reasons for that. I mean, one is just that I said it earlier, there are so many things we want to be buying at the moment. And the second, and again, you're going to hear more about this, and one of the reasons that we're so excited about the outlook is the IPO market. And I've actually got a slide on that. Currently, well, you're going to hear, we think the market is undervalued. Our market is undervalued. And we ourselves on a discount of 6% at this time. We are definitely what we would describe as inexpensive, especially for the strong performance which you can see over on the right. In the appendix, there's a slide on how we approach investing, and if any questions come up later, I can happily turn to that. But if I just say in very brief summary, the process which we use, we have a sort of underlying philosophy which feeds through into a process, and we focus on three particular sort of factors within our portfolio. And these are, first of all, valuation, and we look at two metrics there. So absolutely key focus is free cash flow, and the second one then is the sort of humble PE. So valuation, obviously absolutely crucial. Secondly is quality. And again, I should say there isn't a fund manager alive, and definitely not a small cap fund manager, who won't talk to you about quality and quality of management, etc. And we can and do exactly the same. But when I'm talking about quality in terms of metrics within the portfolio, we focus very much on balance sheet. So the sort of two key areas, we look at ROIC in particular, and also return on equity. And then the third kind of key factor that we target very much is momentum, and largely that is earnings momentum. We also look at price momentum, but earnings momentum in terms of what we want to know is how a company is doing on the ground versus expectations. First of all, versus their own expectations, and then very much against the expectations out there in the market, so the sell side analysts, and we very much use and utilize those analysts. So before I talk about the specifics of here and now and why we think Britannia really is, this is our time. This is our time in the sun. Actually, I'm going to talk about longer term performance of the small and mid caps, and a couple of reasons why we think that is the case. But so first of all, what we've got here is a chart which goes back to 1995, and here we've chosen kind of more the mid cap arena. But and I promise you, the key point here is, we didn't choose that starting point. If you go back further to do it more recently, in general, this chart remains very, very similar. So you can see, despite obviously the dramatic drawdown in 2020 with the consumer bias within the mid cap market, but you can see that it's not just the UK, it's the UK mid, European smaller companies, which is very much a sort of mid-cap market, and indeed the Russell 500. So there is something just in general over time going on in this area of the market that generally leads to outperformance, and over the long term clearly does. And there are, as I say, there are various drivers here, but one of the obvious reasons, and when we talk about strong growth, and so this isn't just about recovery, this is about small companies in niche markets, but with a great growth runway. Again, because they're small, they tend to be very, very nimble. Because they're small, also, when they do M&A, and a lot of our companies do M&A, and for the right companies and the right M&A, we absolutely encourage it. Almost invariably, they don't bet the company on M&A. It's small additive bolt-ons, and they tend to come very cheaply, much more cheaply than for sort of your large cap M&A, because again, in general, a lot of our companies, they would have been courting these small acquisitions, and sometimes these courtships can take between 5 and 10 years, not a sort of quick 5 or 10 day turnaround that Goldman Sachs knocked on your door and said, well, we've got a great idea for you. So they really know what they're buying, and the companies, these smaller companies, like to be part of a larger group where they can see the growth runway. So that's been another of the drivers, and plus, of course, as they being small and dynamic, they tend to be innovative. So if we turn to the next slide, if I can get my sorry, I've got a new laptop and it keeps going dark on me. So the next slide, before I turn to specifics, is about IPOs. So everyone will be very aware quite how many IPOs are going on in the market as we speak. I mean, we are. I think the only word actually is inundated, and possibly the real word is overwhelmed. So we and I in particular have always spent a lot of time and effort on IPOs. Various reasons why. I mean, as you can see, some of the bullet points for us, because as well as this, our closed-end investment trust, we also run open-ended money. So it is a great liquidity opportunity when these companies first come to market. But also, very, very importantly, it tends for us to be a very significant source of alpha. And if I look through the portfolio now, and at almost any time, the number of companies that we have owned for IPO, whether that was 3, 4, 5, 7, 9 years ago, that we've maintained within the portfolio, it really is testament to the fact that IPOs can be a fabulous place to find investments. But unsurprisingly, you have to kiss a lot of frogs, and you have to do a lot of legwork to get there. So my colleague Ed put together this slide, in fact, for our smaller companies investment trust board, and here are just some of the examples of recent IPOs that we've taken. But first of all, if you look at this table and these stats, so this is up to the end of May, and you can see the number of IPOs that are relevant for our company, for our investment trust in terms of size, etc. We automatically discount some as being either literally too small for us, or going to have incredibly small free float, which is something that we do care about, because we think always about liquidity, even though of course this vehicle is closed-ended. So we're never forced sellers, but if we want to exit, we always we want to be able to. And then other, I mean, there are certain sectors that you will pretty much never see us in, and that will be it'll really be the dynamics of the stage of those companies. So a company that's not yet making a profit is just too early stage for us. Occasionally we'll even take those meetings, but normally we'll just wait and watch and see how they do, and then go back and revisit when the company becomes profitable. So immediately, you know, we knocked off a number of names as just not not fitting our criteria, and then went and did a huge amount of work on the rest. And that work, you know, obviously nowadays how it tends to work is you'll do an early look meeting. So myself or my colleagues, and in particular Ed, will take an early look, and so then come back to us and say, this is what it looks like, and it's looking really interesting. Shall I go away and do the work? The work then obviously is speaking to analysts, drilling down into forecasts, very, very key focus for us. How sensitive, how sensible even, and how conservative are those forecasts that this new company is going to come to the market with. And then he will also often do a serious deep dive back into Companies House, deep into Companies House. On one occasion, pretty rare this one, but you know, he actually went and did a deep dive into the last 10 years of a company, so that we could really get ourselves comfortable with what we're buying. And then you can see the number that after all of that hard work that we actually chose to invest in this period. And so we really do discriminate. And as I say, there'll be a number of reasons I mean, we may just not actually like the business model when we come up close to it. We may not like the valuation, in which case that's never wasted time, because if the company floats and the shares get cheaper, let's say, you know, that's a potential opportunity for us. And other times, as I say, we don't actually believe the forecasts, and let's say the margin progression. And again, you know, when we've said no to an IPO, that doesn't mean no forever. It means no for now. And if we're wrong, you know, we'll revisit and buy it at a later date. And then over on the right, you can see, well, to be honest, you can see the reason why, looking at these excess returns, why we spend a lot of time here, because, as I say, when you get them right, you know, they're very right. And you can see that over the last year, we have done very well in this space, and hopefully that will continue. So if I move now to the next slide. So cool, Britannia. Why are we sort of quite so excited about the outlook at the moment? When I was asked if I would participate in this event today, and you know, I was told it was cool, Britannia, and obviously we had a discussion, and it was laid out to me, you know, why Kepler, you know, wanted to do this event and what they were talking about. And I literally just said, well, I think you've been listening to my presentations, because this is exactly what we've been saying anyway. You know, we've been out there marketing away, because we just think this is such an exciting story, the UK mid and small cap. So first bullet point, you know, it is obvious, but it is worth stating. The UK is definitely geared into recovery. I mean, I think we're all seeing that. We're seeing it in so many metrics coming out at the moment. And our fund has very much been positioned that way. Just to caveat that doesn't mean, you know, the entire fund, and then you'll see our top 10 in a moment, you know, is geared into reopening, reflation, or you know, all these names you want to call it. There are a lot of names in there, and indeed in our top 10, and in fact in our top 3, you know, they've been there for a long time. They remain there. But as overall, definitely, you know, the fund is positioned to benefit from recovery. Within the Numis index, the UK represents, it's actually a little under 50% of the investable index. And we have positioned ourselves to be significantly overweight. So we're actually 13% overweight, and we're just over 60% of the fund is UK focused. Within that, again, you'll have seen, read, heard this number, and I mean, everyone has a slightly different number, whether it's 125, it's 150, it's 175 billion. Whatever the exact number is, that's the estimate of the excess increase in household savings last year. We're already starting to see this, and we just have no doubts in our mind that a proportion of that is going to be spent. And right now we're all spending it in the UK because we're not allowed to leave the country pretty much. And, you know, so where's it going to go? Well, very largely it's going to go into UK consumer facing companies, so retail, the pubs, etc., etc. And so again, it won't surprise you to know that we've got a very large overweight towards the UK consumer, and indeed sector wise, the largest overweight we have relative to benchmark, and it's significant, is in general retail. A final kind of more macro sort of allocator point is I've been tracking the Bank of America Merrill Lynch surveys on global investor allocation. And again, you'll be very aware of this. For the last 5 years, basically since 2016 and the onset of the Brexit referendum, the UK's market has been the pariah, and there was almost a 30% underweight to the UK really within the last year. Brexit is done, and I say that with all the right caveats. You know, we read the newspapers every day. We can see, you know, live issues going on, and issues for the broader world, definitely for Ireland, but actually also, you know, for some of our companies, there are teething troubles. Let's politely put it like that. But the key point for us is that Brexit is done. You know, that deal has been signed, and you'll have heard it said before, it will be said again, it is utterly true that for companies, the most important thing that they can have is certainty, to know where they're at, know that this is done in the case of Brexit. And so just, you know, have that backdrop against which to plan for the future. So that's been a crucial part, again, of why we've been so positive on the UK. And turning to the next slide. So I've just put a few macro slides together on this, and actually, you know, I picked these carefully, but actually these are slides that are produced for me every week. Every week I look at this. You know, this is just such a snapshot of the world. The first point I should note. So as I said, we're you know.
Georgina, do you need assistance?
Can you hear me?
Yes.
Good. I'm just coming back in. Am I on public speaker? I hate WebEx. I don't know what happened. It just closed down on me.
Would you like us to move the slides for you?
Yes, please, because
Okay.
I can't see them. It says you've already got a meeting in progress. I hate this thing. I'm afraid you're going to have to move the slides for me, and I can't see you, but luckily I believe I know my slides very well. So apologies for that. I did say, please, can we do Zoom? I hate WebEx. So luckily I may be an investor in technology, but I'm a very poor user. So going back to these slides on the economic outlook, and top left, first of all, is as I say, the consumer confidence, something that we've been monitoring and tracking. And apologies because this slide didn't get updated, but the most recent consumer GfK consumer figures, which came out, I believe, about a week ago, they actually demonstrate that we are pretty much back at pre-pandemic levels in terms of consumer confidence. So that is absolutely very significant. I mean, we are still negative, and you can see. So I'm afraid I will harp on a little about Brexit. You can see that, you know, it was 2016 when the consumer turned cautious. So, you know, we do hope with everything that's going on, you know, in the UK, with economically, but also with the success of furlough and you know, just in general, that confidence will be regained and we'll actually get that over the line and back into positive territory. household saving ratio, I think I've discussed that. And the other very important one, which again everyone is aware of, again you can't open the newspaper without reading about it, but is of course the house price index, the house price inflation, and that is a prime indicator of consumer confidence. So it's part of the reason why we're the two key reasons are the excess household savings for those of us lucky enough to have been in work and unable to spend last year, and then, as I say, of course, the rise in house prices. And you can see over on the right, the effect on retail sales. So if we move to the next slide, and market valuation. So the figures I've put here are from Peel Hunt. And again, there's various sources, but we, again, on a weekly basis, we get the Peel Hunt market valuation data. And basically since the start of 2020 and the onset of the pandemic, we focused ourselves, definitely ignore 2020. To be honest, largely ignore 2021. For a lot of companies would still be suffering. And we looked out to 2022. And so looking 18 months out from now, our market is on sub 13.5 times PE. And if you look at the median earnings growth for both this year, 2021, and next year, it's almost 20% each year. Again, some of that is not at all a surprise. It's a bounce back from the declines for a lot of companies last year, but actually 40% growth in 2 years, and you're paying 13.5 times for it. Really, really a number we're comfortable with. A couple of other points on that. If you look at actually what's going on the ground, and again, Peel Hunt and others have put out a very recent piece on this, the crucial point is that earnings growth figure is heading up, not down. We are seeing a lot of upgrades coming through in the market. As I mentioned, estimate momentum is something that we focus very much on, and we're literally seeing that on a daily basis. And most recent trend, I've really noticed this in about the last 6 weeks or something, is actually the number of unscheduled trading updates. And I'm talking about positive ones. So, really, and some of these are, significant, like a 20-30% upgrade is actually not unusual at the moment, given the extraordinary dislocation in markets last year. So we think that PE is actually overstated because the growth, the earnings will be higher. So a question that I've been asked a lot for the last 6 months, actually longer, is, especially in smaller companies, which have clearly done incredibly well, and you saw that from the index data on the first slide. Have we missed it? Have I missed it? Is it all over? And this is the number one reason we say no. And the number two is obviously the economic backdrop that I just talked about. If I turn now very quickly, I'm mindful of time. So just the next slide shows our portfolio positioning, and this gives you a flavour. So our top 10 positions as at top 10 active positions as at 31st of March. And again, I'm happy to take any questions on any of these. I mentioned earlier, there were just so many opportunities in the market. There's so many things we want to buy and add to, and you can see within that top 10, 6 of those are within our benchmark. The others got promoted out. A lot of them at the start of this year. We've chosen at this point. Definitely, we're absolute believers. They're ticking every box. So we want to continue to run those, and that's very much our approach. And final slide from me, long-term investment performance, because this is all about the long term. And I think if 2020 taught us anything, that was absolutely one of it, a crucial one. So that was really a hop, skip, and a jump. So final slide here is the summary. So hopefully I've given you a flavour of some of the opportunities for really, truly extraordinary growth by a lot of our companies. We have a process. It's a very robust and disciplined process, and you've seen the strong long-term performance of the trust, both versus benchmark and versus peers. So at that point, given I can't see anyone, I am happy to turn over to questions.
Hi, Georgina. Pascal here.
Hello.
Surviving?
Absolutely.
Okay, we've had a few questions come in, and I'm sorry we've struggled with the tech today, but I guess it has to happen occasionally.
Yeah.
So first one was about household savings, and everyone's heard a lot about huge amounts of money being put aside by people who are stuck at home, but lucky enough to keep their jobs. Is there a risk that with all that money coming back to the economy being expected, is that tailwind potentially overstated? And is the marginal propensity to consume amongst those who save during this time being imagined to be higher than it is?
Well, it's a very good question. In fact, it's a crucial question, and clearly that is a risk. So I'm just going to quote a stat. Sorry, you can hear rustle of paper that I prepared earlier. So this was from the Sunday Times, and he talked about. So this was David Smith. He talked about if households spend. His number was 140 billion. Like I said, everyone's got slightly different numbers. If households spend a quarter of that number over the year, it'll boost consumer spending by almost 3%, GDP by 1.6%. That's the kind of number that's in forecasts out there. It's not that they're going to go and spend it all. I actually have to say my take on this and what we're starting to see at the moment, but it is early days, is they're going to spend more than that, so those numbers are going to be higher rather than lower. But clearly these are unknown until they happen. So we're doing two things. We're obviously looking at all the official data that's coming out about retail spend, hospitality spend, etc. Clearly no flight spend really at the moment. But we're also very much, talking to our companies and looking on the ground. And some of the statistics, so a lot of these companies are reporting, so obviously they report like for likes versus last year, which if you were a retailer with shops, clearly it's an absolutely silly number because their shops were closed last year. Again, it'll depend, per company. But what a lot of our companies are doing is reporting not only year on year like for likes, but actually looking at 2-year figures. And so, you're going back to 2019 normality, if we can all remember what that was like. And I mean, some of these are, I mean, when I say astonishing, so I mean, you saw in our top 10, top 5 even, and Dunelm, their like for likes, the recent like for likes versus 2019 were almost 50%. I mean, there is something going on there, and that is obviously about a company that is firing on all cylinders. It's obviously ticking a lot of boxes, the DIY home improvement, etc. But that's real money going in as well. So absolutely spot on question. We'll tell you at the end of the year if we were right, but everything at the moment suggests we are.
Thank you very much. Just looking at the top 10, someone's asked a question about house builders, and Vistry is obviously in there amongst them. The question was that with the end of stamp duty, do you think that will have a major impact on future house price increases, sales volumes, and what are the implications for house builders like Vistry?
So obviously something that we've been thinking about for a while. The immediate answer is that companies, we've all known the date of the end of the advantageous stamp duty, and if you look at recent commentary from the house builders, then they're seeing no let up in buyers. So that's quite clear that obviously absolutely fantastic if you benefited from it, but people aren't, they're not moving house just because of the benefit of stamp duty. That is very, very clear. It's clear this is, we all talked during the pandemic about what was going to change, what the new normal would look like. And in general, our view and my view was, do you know what, the new normal is going to look very, very like the old normal, because the old normal was pretty damn good for most of us. But a couple of things really are going to change. One, I think, and to be honest, personally, I hope the working from home thing, that cat is out of the bag. To what extent we all do it or allowed to, we don't know that, but I don't see us all going back to 5 days a week in the office. And the second one is that because of that, in particular, and also for those people, during lockdown, people had a really good hard look at their homes because they couldn't go anywhere else, and they looked at all their walls a lot. And so, these are decisions that were made during last year about, do you know what? I'm not going to go into the office 5 days a week anymore. Therefore, I can move half an hour further out because I'm not going to waste too much time commuting every day. And, therefore, I can get more bang for my buck, because if you, depending where you choose to live, and I can get the garden for the kids, etc., etc. And those, that's actually happening. That's happening on the ground. So, really, the message is very loud and clear from the house builders. Will house price inflation continue at this rate? Well, honest to God, I hope not, because it's too much. It's too high. And what's fascinating, the number that we keep hearing quoted at the moment is 10%. But I went on a webinar with Zoopla very recently, and they said that actually it's their belief that figure, that 10% year-on-year house price inflation is distorted by larger houses, expensive larger houses in the country, and various other factors. And actually that really underlying is a bit closer to 5, which is still a high number, but it's a lot more reasonable number. We do not want rampant house price inflation. And indeed, that would be a risk, because potentially you might see government taking measures if that was the case. So we really don't want, unless we get it, the house builders don't want that either. They want nice, steady, gently rising enough to counter price inflation, which they're definitely seeing on some products. So, you can see by the size of the position, we still very much believe that market's got a long way to go.
Thanks very much. The next question from the audience actually ties into the last one, I think, quite well. And it's about the sort of difference between consumer spending on durables versus services and the kind of things that people might be able to buy when they're not locked in their houses anymore. Do you see a big shift in that, or do you think durables will still, the kind of things you were talking about, where people are buying new home offices and stuff, the kind of durable home wares, are they going to continue to perform, or is that the end of that?
So again, partly in terms of our positioning, you can see I definitely believe that it's going to continue. It's going to be both, and we're definitely in both. So we're in the services, we've got services exposure too, because we definitely see people spending there. And indeed, the most recent, I think it was the BRC data, showed a decline from the massive ramp up as soon as shops opened, from on a month-on-month basis. And that was not a surprise to us. That I think a lot of people just, there was a fantastic phrase, I think again it was in the Sunday Times, talking about revenge spending, and I think it is both. It is eating out, drinking out, but also as you describe it, the durables. But as I say, I'm going to hark back once again to Dunelm. They are not seeing a let up there. There is no let up there. Another actually is too large for this investment trust. We own it in our mid-cap investment trust. Something like a Travis Perkins. Again, they just had one of these, what I was talking about, the unscheduled trading update. That DIY, a lot of commentators suggested towards the back end of last year that that was a 2020 pandemic phenomenon only. It definitely hasn't stopped yet, and we don't see it, and nor do Travis Perkins see it. The crucial thing, I talked at the beginning about sort of our focus on earnings estimates and earnings numbers out there in the market. And the crucial thing is that neither companies nor analysts have got carried away. They haven't extrapolated the 2020 sort of growth in some of these companies into 2021. They definitely allowed for and forecast much slower growth, which was incredibly sensible, and which we focused on a lot. But as I say, what we're starting to see is those numbers being upgraded again, because these trends are continuing.
Thank you very much. A couple of questions about big thematic drivers of returns. We've had big stylistic rotations in the last year around the vaccine especially. Are you seeing evidence that stock specifics are beginning to take over now, and do you think that will happen in the future if not?
Oh, well, I'm just going to say, whoever asked that question, I could have scripted that for you. That's about my most perfect question. It's a great question. So I actually don't quite know where to start. So we categorically are long-term investors. That's just it's how I work. It's how I think. When I mentioned earlier that we're in stocks for 5, 6, 7, 8 years, that's the truth. They're doing all the right things. We carry on owning them, or own more of them even. So we think long term, and as I say, at the start of the pandemic, we were already thinking about 2022 and looking out that way. So what we didn't do, the crucial thing of what we didn't do in the pandemic was, what we didn't do was panic, and what we didn't do was change entire portfolios. So at the start of the pandemic, I was sitting, remotely sitting with the team, talking, doing a lot of Zooming and talking, and what's going on and what on earth do we think? And my absolute mantra then was, number one, we want balance in the portfolio. At that stage, we had companies which were, you could see 1 or 2 of them, very, very exposed in a negative, very negative way to the onset of the pandemic. And share prices were falling every single day. We also had, some fantastic, what proved to be amazingly defensive companies. I mean, we didn't buy them for that reason, but, things like our several holdings in the video gamers as one perfect example. So I said, what, we don't panic and we don't sell out. We are going to maintain balance. It's going to be very uncomfortable, in this short, I had no idea it'd be that short, but the short, sharp shock of the dramatic declines we saw in the stock market. But we maintained that balance and added to things that had fallen far too far, which were, COVID exposed, as it were. That worked extremely well for us through the summer as the bounce back came, and those things that have fallen 60, 70%, some of them, bounced back strongly. And at the same time, we kept the defensive ones, which continued to do well. Fast forward to November and the fantastic vaccination news, and basically that was turned on its face. And the only stocks that really went up were call it the reopening trade, whatever it is, the vax trades. And we, again, my mantra was balance in the portfolio. If you look at looking at our top 10, Games Workshop, perfect example, really surprisingly had done fantastically well, despite the fact that all its shops were shut most of the year. Actually then was no longer, even though obviously they were going to benefit when the shops were open, by the market, it wasn't perceived as a reopening trade. So a stock like that, very large position for us from, these are approximate figures, but I'm going to make it up. But from November to January, February, that stock didn't move. The share price didn't move. Well, my index went up 25%. That's pretty unattractive relative underperformance. And unfortunately, we're in a relative game here. So, we sat down, we talked, and we agreed, do we still want to own Games Workshop? Are we happy with the valuation? How's the company doing? What's happening on the ground? What are the changes that are still going on? What are the things we're still really excited about, all these levers for future growth? And the answer was yes. So we maintained them in the portfolio. And it was honestly, it was a bumpy couple of months ride. And we just kept saying, we know we're right because we want to own these companies. We absolutely do not want to sell them. And guess what? As results started to come through, which is very much what we hoped, we saw, results season is very significant for, setting the future of share prices, because you could see the strength of these companies and the upgrades coming through. And sure enough, they started to, the share prices started to move again. So I think, you wouldn't know it from reading the financial press, but, actually a lot of that has been happening more recently in the last couple of months. So, and I think hopefully, last year does validate. Our performance validates this approach, which is not to go all one way, not to go all the other. And to be honest, in one sense, don't categorize your stocks as growth or value. Understand why you own them, what the drivers are, and why you think the share price is going to be higher next year than this, and the earnings are going to be significantly higher, etc. So sorry, a long answer, but a great question.
Thank you very much. We are getting towards the end of our time, but I think we should probably have a couple more questions, as we started a little bit late, if you're happy to do that.
Absolutely.
Yeah. There's a couple about, there's one more about the thematic stuff. We've had a big rally in oil and related stocks in recent months, seemingly on the fact that structural shifts towards ESG have constrained the ability to expand supply. Given there are small caps in the oil and gas space in the UK, are you finding any opportunities in this area? It's quite specific.
That is specific. Yes is the answer. I actually, sorry, you can hear me thinking out loud. I don't think I can actually tell you, because literally I have finished buying, but only just. I've been buying specific names where we just think the valuation is astonishing. And if you think of what I talked about earlier, I talk about free cash flow a lot. So when we started to look at the free cash flow on some of these, so yes, to be honest, we've probably done less than one could say. We've done less than we should have done, and less than I might have expected. But I keep reiterating this, right? It is so true. I mean, we literally I have a list of things I want to buy, and they're each struggling to get to the top. And as soon as I get any money from selling something, then it's an absolute debate. Well, do we buy X, which we're desperate to buy, or do we buy Y, or do we buy Z? And interestingly, as I say, yes, I have added in a small way in the oil and gas space, but other areas are shrieking even louder that they need to be bought.
Thank you. Final question, and I guess it ties into that answer really, but also ties into this sort of general feeling of excitement we've seen all day from the various managers we've heard from. If UK equities are in such a good place, and the UK is in this position of potential to sort of rebound strongly, which we at Kepler think it is, and obviously you do, why isn't international capital kind of pouring in, from every direction? Or is it? I'm assuming it's not. And if it's not, is that potentially a tailwind once the rest of the world cottons on and decides they love Britain too?
Well, it's interesting. So I kind of touched on this. So I wish I could remember the exact date, but I mentioned before the Bank of America Merrill Lynch, BAML, let's call it, the BAML survey, which comes out every month, and even as recently as I want to say October last year, UK was a massive underweight, the largest underweight in the developed world. So even then, obviously prior to all the vaccine news, etc., there was this, I mean, absolute 100%, or not 100%, massive lack of interest in the UK. From that minus 30%, global allocators are now overweight the UK. So that has been quite a big tailwind already. Is there further to go? I believe so. Yes, I do. And again, I have to be careful here because a lot of that money obviously goes into the FTSE 100, and people are looking at, FTSE 100 is so different from my area of the market. And that is absolutely seen as a value trade, and I mean you saw that on the valuation chart, but also because of the sectors which have been so unloved and are coming back into favor. So your banks, and indeed as per the last question, your oil and gas. So a lot of that will go into the FTSE 100, but definitely we're expecting to see further interest in the FTSE 250 and indeed small cap. And again, for us, I mean, one of the key indicators, I talked quite a bit about IPOs during the presentation, but again, everyone will be very aware of the amount of M&A going on in this country at the moment, in mid cap and in small cap. And a lot of that is private equity, but by no means all. They don't buy things that they think are expensive. They are just demonstrating to the wider world how much value they see in the UK. And I've got to be really careful, because I said this on a presentation the other day, and then I was speaking to an investor who'd listened to the presentation, then we had a one-on-one, and he said to me, I've just got to check, when you were talking about M&A, were you basically saying, oh, it's great because all my companies are going to be bought? And I was like, oh my God, no, absolutely not. What I'm saying is that vindicates my view of valuation. When you're seeing this kind of amount of M&A, it says our market is very, very cheap. That's good because cheap is still attracting attention, but also all this M&A attracts attention. Then people say, oh, well, wait a moment, maybe I should be in that market because look, it still is undervalued. So I'm very much hoping that yes, this is a tailwind. And one other point to add on that, I actually read a stat a couple of days ago. Even in the UK, so our UK wealth managers, who obviously manage a very significant amount of money, they themselves despite the fact that their clients are UK and they probably live in the UK and generally think in sterling, etc., etc., they've been underweight the UK and they've just gone overweight too, but just overweight. So you like to think that it's not only foreign money, but actually our own money that's going to help create a further tailwind.
Fantastic stuff. We've got no more time for questions, but one member of the audience, I don't know if you can see your end, has written in to say he's a shareholder and to say thank you and well done. So I'd like to echo that and say thank you.
No, well, please, thank you so much. And also, I mean, I can't apologise enough. Sorry, you've got my voice, but really, I'm a lot better fund manager than I'm a technology manager. Let's just put it like that.
Thank you for joining us, and thank you to the audience for bearing with us through those technical problems. Bye.
Bye.